A report from the World Bank delivered their outlook that the world economy faces a bumpy road, acknowledging headwinds from balance sheet restructuring, further debt deleveraging and the impact of fiscal consolidation. But how will these factors affect the performance of the major currency pairs? Joining me down the line for today's dollar-themed Targets in Focus is Neil MacKinnon from VTB Capital, based in London. Neil, the World Bank went on to say they do see these growth restraining factors becoming less intense, which is likely to allow a slow acceleration in GDP growth. But what is your take on market sentiment at present?
Well, I think that as far as real money investors are concerned, I think they do believe that the global economy is starting to stabilise. The Eurozone is still very much mired in recession. Even Germany's not managing to escape that. We've seen that in recent export data, recent data for manufacturing orders. I think the leaders in terms of where the global economy is going is clearly China. Generally, I think the economy is stabilising. I think it is moving towards a soft landing scenario, and I think the sorts of growth rates that we'll see in China over the medium term, while they'll be certainly lower than the double-digit rates over the last few years, as they make the transition to more of a consumer-led economy, then something like 7.5%, which is not too far away from the 5-year plan projections, is quite likely.
If we look at the first pair, fiscal policy is likely to weigh heavy on the dollar, and later on today the Fed will release their Beige Book report for December. Do you think the data itself will have a significant impact on the dollar, and what are your forecasts for it against the euro in the short, mid and longer term?
Well, over the last few months we've seen the euro appreciate as investors reacted positively to the ECB announcement. In its place, of course, there were plenty of worries about fiscal cliff. At the time, in the run-up to the US presidential election in early November, there were also uncertainties about the outcome. But generally, we've seen a rotation away from concerns about the Eurozone fiscal policy and the Eurozone crisis to more on the fiscal situation in the US, which is widely regarded as unsustainable. It's certainly, I think, the dollar has plenty of problems in the pipeline. Markets are aware of fiscal cliff too, whereas at the end of February, beginning of March, the debt ceiling becomes a problem. The so-called sequester on spending cuts that was deferred as part of the Fiscal One agreement, they come under review. So all of these things have the potential to unsettle the dollar, unsettle US Treasury market. So technically, the trend is clearly defined. Euro dollar has to hold around 129, 130. If it doesn't, if there is a decisive breakthrough that, then I think there is scope for a further retracement that could take you down to the 120, 125 area.
For many, the striking FX feature of 2013 so far is underperformance of the yen due to the expansion of the Bank of Japan's balance sheet. I understand VTB believe there is scope for the yen to move down, however. What are the main reasons for this?
Well, I think that the yen is certainly likely to be the funding currency during the course of 2013. The comments that we've seen this week from the economy minister and more recently overnight from the Secretary General of the LDP suggests that they are a little bit worried that the depreciation in the yen may be getting out of hand. So there's been a lot of talk about the Bank of Japan raising its inflation target from 1% to 2%. I think that will happen. I think the next meeting will see further loosening of policy. So any corrections, I think, are opportunities to short the Japanese yen, and ultimately I see dollar yen moving towards the 100 level.
The US markets were in full swing yesterday with the release of core retail sales, PPI and retail sales. We also have Aussie unemployment data released tomorrow, which is likely to weigh on sentiment. But what is your outlook for this currency pair, and what will be the main factors driving it forward?
Well, the Australian dollar is generally regarded as a commodity currency, and some of the cross rates like Aussie yen very much regarded as an indicator of the so-called risk-on, risk-off trade. But if the view of a gradual recovery in global economy is right, which should underpin support for commodity prices and for commodity exporting economies like Australia, then you would expect the Australian dollar to hold up. I'm not sure it's going to be a great outperformer during the course of 2013, but the technicals are very well defined. Whether you're a bull or a bear, and actually do make it somewhat easier to pinpoint entry and exit levels.
Neil, thank you for your perspectives today. Well, that's all for today's Targets and Focus programme. The next edition will be on Friday, focusing on Latin American currencies, so please do click back for that. Bye for now.